Fintech Chatter TV. Presented by Tier 1 People. Leaders in Fintech Executive Search.
Downsizer is a unique blend of digital technology and a financial instrument. Essentially, we help homeowners with enough equity in their current house buy their next house with zero cash deposit. It's solving for two sides of the marketplace. First of all, you've got a construction industry on one side that's building apartments, where increased inflation and interest rates mean there's less approved mortgages in the market, therefore less people buying apartments, and that has a cascade effect on the property stock in the construction industry. So on one side, we've got property developers and vendors selling property. On the other side, which is our buying personas, you've got downsizers. There's data that we have, our proprietary data, that tells us there's 1.7 million Aussie homeowners that are planning on downsizing in the next 5 years. And often they're asset rich and cash poor and don't have the 10% deposit required to exchange off the plan or buy at auction. So we're qualifying those downsizers using the technology that we've built in-house to prove that they have the sufficient equity to buy the next house, and therefore they can enter into agreement through our service at zero cash deposit. Co-founders and I really started this because one of my co-founders, Mike Kelly, is a property developer in his own right, and he would often reflect that for every property he sold off the plan to an owner-occupier, he could have sold 2 or 3 more to buyers that couldn't find the deposit. Our mission is to help an entire generation stop worrying and start living, and really increasingly we're seeing downsizers that want to simplify for whatever reason, whether that's after COVID, it's they want to go traveling, whether it's for health reasons, whether it's for the bank of mum and dad. Often they walk into sales suites up and down the country, or open houses or auctions, and they really like the property, but they have to sell their current one first. So if we can remove that barrier, that means that, developers will sell more stock, vendors and real estate agents will continue to sell. But more importantly, you talked about housing affordability. It's almost a national sport here in Australia, right? And it's not just limited to Australia. But if we can free up 1.7 million or help free up 1.7 million households, that has a cooling effect all the way down through the housing market. So long-held residential stock. This is mums and dads and grands and granddads that have held their property for 25 years. They're carrying a lot of equity. Right? And our data tells us also about 85% of that 1.7 million householders have 3 or 4 bedroom houses.
Yeah.
They don't need them. And yet here we are talking about a housing crisis. If Dexter's got a $3 million house and he wholly owns it or mostly owns it, and he's buying a property for $1.5 million, we don't see that as a kind of credit assessment, because we're not assessing your income. Yeah. We're saying you've got a house that you wholly own or mostly own, and you're entering into a contract to buy your future home. We work with property developers on the other side to say, hey, Dexter's got 4 times the equity in his current house. He's a good bet. Yeah. Compared to maybe a first-time homeowner who's got 10% deposit and 90% LVR mortgage. Yeah. They're higher risk. Right? So if you come through our process and you see a property that you want to purchase, or in fact, if you want to be pre-qualified, we can do that for you so you can go house hunting. And we do that by simply looking at the house that you own, your debt position and equity position in that, and that'll give you a pre-approval to a certain level. That means you can go shop. If you're already in retirement, you don't qualify for bank guarantees or bridging finance, which are, every situation, every consumer should have the choice of whether they want a downsizer bond, which is what we offer, or bridging finance, or a bank guarantee. That's your choice. But if you're 65 and above, you're unlikely to get approval for that because you don't have an income, or you'll go through 3 to 4 weeks of paperwork to prove your income. Yeah. Or if you are still working, again, even if you had a good credit history in this market, it will take you weeks. We can do it in minutes. Yeah. the tech and data and the integration points make it easier for me as a business entrepreneur to connect all of those dots. Our system that we've built in-house is ours. We have 14 different integration points from industry players like Equifax, like Domain, like CoreLogic, like the government's digital verification system. So we're pulling together 14 different APIs into one place to make that decision instantaneous, depending on which state you're in. There's 2 states at the moment that aren't online, so we're kind of subservient to the Land Title Office, for example, in ACT, as 48-hour turnaround, but we can do a decision in principle in minutes. We've been around the block is really the message, and yes, we do have a lot of expertise, particularly in technology, in financial services, strategy, design, implementation globally. That's a lot of our IP and thinking, but we also have at our core human-centered design, which allows us to really look at a problem and a need from different angles. We involve the participants and have involved the participants throughout this design. Two or 3 years we've been talking to people about this concept, and if you involve buyers and developers and sellers and agents and conveyancers in the process throughout, you're continually learning. That builds you the knowledge. We obviously bring some knowledge to the table, but my point is the human-centered design approach that we've used and agile technology delivery married to that means that we've moved pretty fast and pretty quick in building quite a complex set of user needs into minutes. We're in pilot with mortgage brokers. We recognize that from a distribution standpoint, everybody has a part to play. If we were coming here trying to disrupt different industries, that's not what we're doing. We're trying to optimize the ecosystem. Often there's this connotation of disrupting through innovation. I don't think it needs to be too disruptive. I think it can actually be really simplification. There's a real estate sector globally and in Australia is the biggest asset class. There's enough space to play here, and consumers should have as much choice as possible. We have, as I mentioned before, we're in pilot phase with mortgage brokers helping our distribution. But one of the biggest things that's also changing the game for us is we have our fairly exciting news that not many people know. We have our own corporate real estate license, which is really helping us. So we have 5 real estate agents in 2 states that are really helping us handhold the downsizers through the process, because we learnt in our pilot that maybe there was some resistance there from the existing sales models that were maybe resistant to a new thing and worried about introducing a new thing into a property purchase. So we've learnt from that, and we've really gone hard with, you talk about collaboration, we're partnering with a real estate company that has a track record in off-the-plan sales. So now we have access to 5 agents that are helping us retain more revenue. Great path to revenue, just to break even just got quicker, and really help us acquire more developers and make more sales. Friends, family, fools, up until December 2022, so 6 or 7 months ago, we had kept it mostly bootstrapped until that point in time. We were, difficult capital raising environment last year. We were, traveling pretty well. We were getting good indicators in the market, and the music stopped for startups, fintechs, and alike, shifting more towards a faster path to break even and ARR. Where we ended up through that really challenging time, I'll be honest with you, it was really tough. But we landed with a strategic investor. It's publicly available, right? So our strategic investors are the Lombard Group, who are actually a insurance family, let's say, of multiple brands globally in 12 countries. They've taken a strategic position in us. They are patient, they are supportive, they are our bond provider ultimately. So what that means for us is a couple of things. We've been able to iterate on the bond financial instrument quickly with feedback from our developers and our clients alike, so we can move quicker and we're more agile than a financial institution I've been used to working in. We have access to the distribution network through their mortgage broker network, so that allows us a greater reach. So December we raised $3.4 million on a valuation of about 12.5. As I said, difficult environment. Since then we've kind of scaled from 3 states to 5 states in Australia. We've completed $30 million of property sales off the plan. We've actually had one existing property as well. So we're moving into different use cases. So $30 million of sales. We now have developer stock for sale on our site in 5 states that's worth currently $1.5 billion, with another $1 billion of property about to be loaded and published as soon as the developers kind of release their projects. People size, we grew from 5 contractors, including myself, in December to 11 employees, some part-time, mostly full-time, and another 15 techie contractors. So we've scaled up very quickly from a human perspective. Yeah, I mean, I've had a number of health issues myself. So I had worked in large corporates for all my career, but maybe 26 years at that point, something like that. And I began to really believe the more research we had on this little idea that we kind of put together. The more research we did, the more customer-centered design we did, the more obvious it became that this is a genuine macroeconomic opportunity. So that really excited me about jumping on and creating something from scratch. I sometimes regret that because it's hard. It is hard. I've learned more in 3 years than I've learned in 30 years. The biggest points of pride for me this last few months is that we as an organization created our first set of values, and one of them is that growth mindset. And looking at things in a different way, because if you don't do that, you're not learning, you're not moving forward, and you're closing off to opportunities. So if you go back to what drove me away from a corporate environment, there's a lot of energy and a lot of excitement that only this kind of environment can bring. It can be heartbreaking at times. It's been really tough. I'm not going to lie. It's hard out there, but it's ultimately really fulfilling. Definitely, my observation is that we're in danger of stalling from a fintech, insurtech perspective. Absolutely. Funding, we witnessed firsthand when the music stops last year, and I mentioned at the top of the show, we're actually really happy with how that ended up for us, because we now have a strategic partner that's patient, and we're one of the lucky ones. But we don't take that for granted. We're diversifying. Certainly, we've listened to the market, and Downsizers like one brand of many that we have in our pipeline. So we are diversifying to protect ourselves. From a what needs to happen standpoint, I mean, that's a very big question, but some observations from me anyway. I see these big funds, and I'm going to shoot myself in the foot here probably, but I feel like early stage startup seed investment in Australia just doesn't seem to be as prevalent and as easy, not easy, but as mature as it is in America and in the UK. In the UK, there's great tax incentives for investors for seed rounds, where you can get, I think as an investor, you can get up to £250,000, and 50% of that is kind of almost protected from a tax incentive from the UK. So you only need 10 of those in the UK, and you're away. I feel like a lot of the VCs here, some of the VCs want to follow on and protect, and they're in a difficult position, right? Because we had advanced talks with one, and they said they had the choice of investing in us at a seed round or bailing out 10 that they'd helped in 2020 and 2021. So I feel for the VCs, but I also feel that we need to get maturer in early stage entrepreneur and backing them, because I feel like the check sizes seem massive for something that's proven, but it's not evenly distributed for lots of amazing ideas and people that have come into. When I think about all the neobanks that have tried, to our point early on, I applaud every one of them for having a crack. There's a lot of lessons learned there that we're going to lose. The IP, if I had a business and it was disappearing like that, as a government that was giving out the licenses, I'd be trying to harvest as many of those learnings and those people as possible. Next 12 months for us, scaling in Australia, obviously. Our componentized architecture means that we'll be releasing different brands. So we'll be releasing a white label solution to the market October, let's say. And then we're already looking at adjacent opportunities like boat deposits. So if Dexter is retiring, and I know he's got a $3 million house and he's buying a $1 million house, I know he's good for another $500,000 boat if he wants to go cruising around in his retirement. So we're starting to look at those adjacent opportunities that downsizing releases. And I guess the medium to long term is we will be looking to pilot in the UK early 2024. We're fairly far down the path of finalising that pilot participant. So yeah, we're going pretty hard, but the funding is going to be a challenge for us at some point, the same as it will be for everyone. The runway's only long enough if you're not getting the revenue in the door. So it's going to be tough, but we've got some big plans.